Now for chapter 2, since we already know that what type of company we can have, what kind of reports we're preparing for the companies, how often we're preparing those reports, we can start talking about analyzing the transaction that happened in the company and their effect on the financial statements. Those are the learning objectives: to identify the accounting standards, explain the qualitative characteristics, explain the differences between cash basis and accrual basis, and explain the accounting equation again, which is asset equal to liability and equity. Start analyzing the transactions to summarize the effect on those transactions and calculate and interpret the ratios for the profitability of the company. First, with the accounting standards. Well, since the financial reports are prepared for the users, which users are different in the nature, creditors, lenders, management, and all coming with the different backgrounds, and all trying to analyze the different companies, each company has to follow some kind of rules. For that reason, we have these accounting standards. In Canada, company applies two standards: either International Financial Reporting Standards, either accounting standards for the private enterprises. So the objective for those standards is to produce financial reports which are useful to financial statement users, and they can compare different companies by knowing that those companies apply these standards. The responsibility: who is responsible for setting the standards and communicating the standards with the industry? That will be Canadian Accounting Standard Board. International Financial Reporting Standards, however, are responsibility for the International Accounting Standard Board. Conceptual framework is something that give you the foundation of the concepts and objectives. In this case, since we're talking about accounting reports, accounting practices, we have to have some foundation where we have to set up the objectives and concepts which is going to guide the accounting standard setting body to come up with the new standards or revise the old one, come up with the new ideas how to report different events. How the conceptual framework is developed? International Accounting Standard Board is the one that's dealing with the conceptual framework. The objective is to help the organization to develop financial reporting standards, to assist the accountants to determine how the accounts for terms has to be specified in the standards, and if there's not part of the standard, part of the definition not to be reported, and to assist the users how to interpret financial statements. For that reason, every standard, every conceptual framework, every foundation has characteristics. For the accounting purposes, we have fundamental characteristic and enhancing characteristics. Fundamental characteristics sitting on the relevance, faithful presentation. Enhancing is comparability, verifiability, timeliness, understandability, constraints. So on the relevance, we're going to see that predictive value. What that means that we can, based on the past events, we can predict how the company is going to go in the future. confirmatory value is the one that the amounts on the financial statements are confirmed, checked, rechecked, and confirmed by the auditors, so we can rely on that numbers. Materiality is related to the if there any mistake, that mistake will be very small, and that's not going to affect our decisions. In order to be faithful to that presentation, we have to have completeness, means that all the events that happen in the company are recorded and posted in the financial statements. Neutrality is that only events which are related to the business are recorded in the financial statements, and that information is not biased, is neutral. And the freedom of error is there's no mistakes. Why do we need to achieve those ones? In order to compare the statement with one company to another company, to verify the numbers, to receive the reports on the timely fashion so we can make decisions, and the reports to be understandable enough so the users with the sufficient accounting or financial background to read the reports. And we're always going to have the constraints, which is constraint will be the cost versus benefit. One assumptions that we're going to see is the going concern basis. We're always going to assume that the corporation or the entity is going to continue to operate for the foreseeable future. So the going concern means that this company is not going to shut down in 2 months. It's essential if the company is to be able to realize its asset and discharge the liability in the normal course of action of the operations. So that means company is not going to disappear just like that. If the investors see that there's a going concern problem with the company, that means the company is going to shut down in the next 2 months. They're not going to invest in the company. Creditor is not going to lend you money. Here we're going to the cash basis versus accrual basis. Means that on the cash basis, we're going to record events only and only when there's exchange of cash. Once we receive the cash, we're going to record the revenue. Once we pay the cash, we're going to record the expenses. Accrual basis is different. In accrual basis approach, we don't care when the cash has been received or paid. We care when the event happened. So in that case, the revenue is recorded when the revenue is earned, not when the cash is received. And the expenses are recorded when they're actually incurred, not when the cash is paid. Revenue recognition. Under the National Financial Reporting Standards, we have a 5-step process to determine when the revenue should be recognized on the financial statements. We're not going to go to those 5 steps. Those are for the accounting people. Don't get scared. We just want to know, I want you to know that there's a process where we're going to determine is the revenue should be recognized in the financial statements or not. So generally, companies should recognize the revenue when it's earned. What that means earned is that when the company satisfies performance obligation on the contract, now sounds very scary, but means that when the company delivers the service and when the company provides the goods to the customers. On that point, when the goods are in the hands of the customers, we're going to recognize the revenue. When we deliver the service, we're going to recognize the revenue. The fact that the customer hasn't paid us yet, it doesn't change the fact that we delivered the service. In that case, we have to record the revenue. Accounting equation, we already talked about it. That's asset equal to liability in shareholders' equity. How are we going to calculate the retained earnings? Retained earnings, we already said that retained earnings will be the beginning operating retained earnings. We're always going to add the net income, which net income comes from the revenue minus expenses. And we're going to deduct the dividend that we pay to the shareholders. And that's how we're going to get the ending retained earnings, which is going to be opening retained earnings in the next period. Next period, we have to add the net income again, deduct the dividend declared, and we keep going, keep going, keep going. In order we to start or record the events in the company, we're going to use this template approach. For this template approach, what I'm going to do today, at the end of the lecture, I'm going to post you an Excel spreadsheet, which I want you to have on Thursday. And on Thursday, we're going to start doing the transactions one after another. That's going to happen here in the chapter. So we're going to go through the whole process of recording assets, liability, equity, assets, liability, equity. There will be revenue, there will be expenses, there will be dividend declared. Recording transactions will be every transactions must affect the two accounts. And we always have to keep in balance asset equal to liability and equity. If we follow this rule, you're never going to make a mistake. That's why accounting is super easy. You just have to keep it in balance. Retained earnings will be affected, or the net income will be affected by changes in the revenue expenses. So every time when you have revenue, retained earnings is going to go up. Every time when you have expenses, retained earnings is going to go down. Why? Because revenue minus expenses and net income. More expenses, less income. And retained earnings will be affected by the dividend declared. And from the next slides, there's the transactions one after another. Now, we can do those transactions in the class. They're very interesting. And we can discuss those transactions in class so you can see how everything goes through in the accounting process. That's those how many transactions are 16, 17, 18, and we're going to come up with this template. We're going to do this in class. I'm going to post you this template. That's Excel spreadsheet. I want you to have it in class, and we're going to go one after another over this Excel spreadsheet. So what will be if we're using this spreadsheet, which we're going to use, what will be the limitation of this approach? Well, the number of the column within the template. So if you want to have more columns, so basically, can you do accounting on the Excel? Yes, you can. The only thing is that table is going to get bigger and bigger and bigger and bigger. And the other thing that the other limitation will be, we're not going to have enough information about revenue, expenses, and dividend. After we prepare this Excel spreadsheet, then we can prepare the statement of income. Why? Because we can easily see the revenue and expenses. Then we can prepare the statement of the changes of equity. Why? Because we can easily see how much is the income or retained earnings that's going up and dividend that we paid. Then we can prepare the statement of financial positions, which is the balance sheet, asset equal to liability and equity. And the last thing that we can do is the statement of the cash flow. And we're going to prepare all those statements in class. The one thing, why do we doing all those statements? Because we want to analyze how the company performed. Is the company have ability to generate income? We want to see the revenue minus expenses. Is the company has ability to generate income? Is there any value for the shareholders in the company? What's the assets in the company? What's the liability and equity in the company? And then we can prepare the cash flow to see how much the company generate cash from the operating activity, how much they're spending on the investing and financing. And the last thing is to calculate the ratios. Which ratios? We're going to talk about those ratios. We're going to talk about the profit margin ratio. We're going to talk about the return on equity. And we're going to talk about the return on assets. Because every shareholder wants to know how much he gets for the money that he invested. And what's the ability of the company to generate income from the assets the company has. And that concludes our chapter 2.